They're calling it a ticking time bomb. In 2026, the United States doesn't just face a deficit, it faces a wall. $9 trillion of national debt comes due in a single year, nearly one quarter of everything the government owes. Social media says default is inevitable. Headlines say collapse is unavoidable. Politicians won't touch it. Wall Street barely whispers about it. But here's the truth no one is explaining. This isn't a debt cliff. It's a hidden refinancing machine. And the way it really works is far more disturbing than the panic narrative. The number itself is what triggers the panic. $9 trillion, due in 1 year. When people hear that, they picture the government needing to come up with a mountain of cash overnight, as if 2026 is some kind of payment deadline that decides whether the system survives or collapses. But before fear takes over, the structure has to be understood, because this isn't a single bill coming due. It's a schedule of contracts expiring one after another across an entire year. Start with what the debt actually is. The US government doesn't borrow in one form, it borrows in three. Treasury bills are the shortest, lasting from 4 weeks up to 52 weeks. Treasury notes run from 2 to 10 years. Treasury bonds stretch out to 20 and 30 years. All of it is debt. All of it has maturity dates, and all of it eventually has to be repaid or replaced. That replacement process is what matters. Now put scale on it. The total national debt is about $38 trillion. The $9 trillion maturing in 2026 is roughly 24% of everything the government owes. That sounds like a cliff, but structurally it isn't one event. It's thousands of separate securities expiring across 12 months. There is no single day where $9 trillion must be wired out. It's a rolling sequence of maturities that happens continuously. This is where the misunderstanding begins to break down. When a treasury bill matures, the government doesn't walk into a vault and pull out cash. It issues a new bill. The old lender gets paid and a new lender steps in, often the exact same institution. That process is called rollover, and it is not an emergency measure. It is the core operating system of modern sovereign finance. To see why this isn't funded by taxes, look at cash flow reality. The US collects about $5 trillion a year in tax revenue. It spends around $7 trillion. That $2 trillion gap is already borrowed annually. The $9 trillion maturing in 2026 sits on top of that. There is no mechanism to raise $9 trillion in extra taxes. There never was. Refinancing is not a choice. It is the only structural option. This is the pivot point. Once it's clear that repayment equals replacement, the framing changes. The real question stops being, can the government pay $9 trillion and becomes, who will hold the new $9 trillion when the old one expires? And that leads directly into where the money actually comes from. Once the idea of rollover is understood, the panic narrative starts to collapse. The government is not standing in front of a vault labeled 2026, trying to scrape together $9 trillion in cash. That framing is wrong. The system is built on refinancing, not liquidation. Every time a security matures, a new one is issued. The repayment and the new borrowing happen as part of the same transaction cycle. This becomes obvious when you follow the money flows. The US government brings in about $5 trillion a year in tax revenue. It spends roughly $7 trillion. That already requires around $2 trillion in new borrowing every single year just to keep operations running. The $9 trillion maturing in 2026 is not replacing that deficit. It is in addition to it. There is no universe where taxes are raised by $9 trillion. The entire federal tax base isn't even that large, so the system is not designed to pay maturing debt down. It is designed to replace it. This is why the word repayment is misleading. On paper, the government pays back the lender when a treasury matures. In practice, that same pool of money is usually reinvested into a new treasury issued minutes later. The old contract ends. A new contract begins. The debt doesn't disappear, it changes maturity dates. That's it. This also destroys the idea that 2026 is a one-time shock. The US already refinances trillions every year. It has done this continuously for decades. The only difference now is scale. When total debt was $10 trillion, refinancing $1 trillion didn't sound dramatic. When total debt is $38 trillion, refinancing $9 trillion sounds apocalyptic, even though the process is structurally identical. This reframing leads to the real constraint. The question is not whether the government can issue new debt. It does that constantly. The real question is whether there will be buyers willing to hold that new debt at the yields being offered. That's where fear should be aimed, not at cash availability, not at some imaginary repayment deadline, but at the demand side of the Treasury market itself. And that demand doesn't come from foreign governments alone. It doesn't come from some mysterious pool of global savings. It comes from inside the US financial system, hidden in plain sight. Once the focus shifts from finding cash to finding buyers, the real machinery of the system comes into view. The funding source for this rollover is not some emergency foreign bailout. It is not a last-minute rescue package. It is domestic liquidity that is already parked inside the financial system, waiting to be recycled into treasuries. Start with money market funds. As of mid-2025, they hold roughly $7.4 to $7.5 trillion in assets. That number alone is almost the entire 2026 maturity wall. These funds are not sitting in cash. They are primarily invested in Treasury bills. When those bills mature, the proceeds do not leave the system. They remain inside the fund and are automatically reinvested into newly issued bills. That is not speculation. That is how money market mandates are legally structured. This same mechanism extends far beyond money market funds. Brokerage sweep accounts quietly move idle cash into short-term treasuries every night. Pension funds use treasuries as collateral and liquidity buffers. 401(k) plans hold treasury-backed stable value funds. IRAs park uninvested balances into government securities. Even banks take customer deposits and channel a portion into treasuries to meet regulatory liquidity requirements. What looks like cash from the outside is, behind the scenes, already loaned to the government. This creates a closed funding loop. When a treasury bill matures, the government pays back the holder. That holder is usually a money market fund or a bank-managed vehicle. The same institution then turns around and buys the next treasury issuance. The lender doesn't change. The money doesn't leave. Only the maturity date updates. This is why the system does not need to attract $9 trillion in new capital. A massive share of that capital is already locked into treasury products by default design. It is already inside the refinancing pipeline. This also explains why treasury demand appears so stable even during market chaos. It isn't driven by retail sentiment. It is driven by structural cash management rules. Institutions are not choosing treasuries because they are excited about government debt. They are choosing them because they are required to. This brings the narrative to a dangerous misunderstanding that keeps resurfacing. If all this money is recycled automatically, what happens if people pull it out and invest it somewhere else? That illusion is the next thing that has to be dismantled. When the hidden buyers are exposed, the next fear takes over. What if everyone pulls their money out at the same time? What if all that cash leaves money market funds, brokerage accounts, and banks, and floods into stocks, gold, crypto, or real estate instead? This is the moment where the entire panic narrative collapses, because it is based on a fundamental misunderstanding of how money actually works. Money does not vanish when it moves. It never exits the system. It only changes ownership. If someone sells treasury holdings and buys stocks, the dollars do not disappear. They move from the buyer's account into the seller's account. The same number of dollars still exist. If someone buys gold, those dollars transfer to the gold seller's account. If someone buys Bitcoin, those dollars transfer to the Bitcoin seller's account. In every case, the system still contains the same pool of liquidity. Nothing is drained, nothing is destroyed. This matters because wherever those dollars land, they still have to sit somewhere. They do not float in the air, they end up in a bank, a brokerage, a clearing account, or a settlement account. And once they are there, institutional rules push them right back into short-term government securities. Banks are required to hold high-quality liquid assets. Brokerages sweep idle balances into government money market vehicles. Pension funds and asset managers park unallocated cash into treasury-backed instruments. The dollars keep getting recycled into the same pipeline. This is why money market fund balances tend to trend upward over time, even during market booms. They are not a sign of fear. They are a structural reservoir of collateral. They grow because the system creates more dollars, and those dollars must be stored somewhere safe, liquid, and regulation compliant. Even if trillions shifted out of money market funds in a wave of speculative mania, the cash would still reappear inside the banking system within hours. And from there, it would be pushed back into treasuries by design. The idea that investment flows can starve the treasury market is not just wrong. It is mathematically impossible under the current monetary architecture. This dismantles the last piece of the liquidity collapse myth. The rollover is not threatened by people reallocating portfolios. It is protected by the plumbing of the financial system itself. And that leads to the next reality that no one wants to confront. Most of the 2026 debt is not even long-term. It is overwhelmingly short-term by construction. Once the liquidity myth collapses, the timeline itself has to be interrogated. Not all debt behaves the same when it matures. The impact depends entirely on what kind of debt is expiring, and this is where the numbers quietly expose the truth. 2026 is not a long-term refinancing crisis. It is a short-term rollover wave dominated by Treasury bills. Look at the interest rate fingerprints. The average interest rate on all outstanding Treasury bills right now is about 3.98%. That matters because bills mature in 12 months or less. Compare that to current market rates. 1-month and 3-month bills are yielding roughly 3.6% to 3.8%. That gap tells you something critical. It means a large portion of existing bills were issued within the last year at slightly higher yields. In other words, a massive share of the debt coming due in 2026 was created recently and is already short-term by design. Now contrast that with longer maturities. Treasury notes, which run from 2 to 10 years, carry an average interest cost of about 3.13%. Yet the current 2-year yield is around 3.5%, and the 10-year is near 4.1%. Treasury bonds, which run 20 to 30 years, average about 3.34%, while the 30-year market yield is close to 4.8%. This creates a clear signal. Rolling long-term debt right now would sharply raise interest costs. Rolling short-term debt would not. That incentive structure explains the maturity wall itself. Over the past 2 to 3 years, the Treasury deliberately shifted issuance toward bills and short notes. It shortened maturities to avoid locking in high long-term rates. The strategy was simple. Wait for the Federal Reserve to cut short-term rates, then refinance repeatedly at cheaper levels until long-term yields become politically or economically tolerable again. This means the $9 trillion figure is misleading in another way. It is not $9 trillion of 30-year bonds coming due. It is mostly rolling paper that was never meant to stay outstanding for long. It is refinancing pressure, not structural refinancing danger. This changes the emotional framing completely. A short-term rollover event behaves nothing like a long-term debt trap. It doesn't explode interest costs. It doesn't force brutal budget trade-offs. It actually creates a window where interest expenses can flatten or even decline. And that brings the next fear into focus. Even if liquidity holds, does refinancing all this debt blow out the federal interest bill anyway? That question only makes sense once the maturity mix is understood. Once the maturity mix is clear, the interest panic starts to fall apart. The danger is not the act of refinancing itself. The danger is refinancing at higher rates than the ones already locked in. And this is where the numbers flip the entire narrative upside down. Right now, the average interest rate across the entire national debt is about 3.38%. Break that down, and the pattern becomes even more revealing. Treasury bills carry an average cost of roughly 3.98%. Treasury notes average about 3.13%. Treasury bonds sit near 3.34%. These are not market rates. These are the blended rates of past issuance. They represent what the government is already paying. Now compare those to current yields. The 30-year Treasury is near 4.79%. The 20-year is around 4.76%. The 10-year sits near 4.1%. The 2-year is about 3.5%. 1-month to 1-year bills are roughly 3.6% to 3.8%. This comparison exposes the real constraint. Rolling long-term or even mid-term debt right now would spike interest costs sharply. Rolling short-term debt would not. This is why the 2026 wall does not translate into an interest explosion. If most of the maturing debt is short-term bills already costing nearly 4%, and new bills are being issued below that level, the refinancing process mechanically lowers the interest burden on that portion of the debt. That is not theory. That is arithmetic. Even if rates stay exactly where they are, rolling 3.98% paper into 3.6% to 3.8% paper trims interest costs instead of raising them. And that is before accounting for the Federal Reserve's stated path toward further short-term rate cuts. Every 25 basis point cut translates into tens of billions of dollars in reduced annual interest expense as short-term debt cycles through refinancing. This destroys the idea that 2026 is an automatic budget bomb. The structure of issuance has already prepositioned the Treasury to benefit from falling short-term rates. The only scenario where interest costs explode is one where long-term debt is forced into refinancing at today's elevated yields. That is precisely what the Treasury has been avoiding, which leads to the deeper layer of the story. This entire strategy only works because monetary policy is quietly aligned with it. The refinancing math does not exist in a vacuum. It is being actively engineered by the central bank. When the interest math is exposed, the next layer becomes unavoidable. This refinancing wave does not succeed on Treasury strategy alone. It only works because monetary policy is being bent around it. The central bank is not a background actor here. It is the structural enabler. Start with where policy pressure actually matters. The Federal Reserve does not control the 30-year yield. It does not directly control the 20-year or even the 10-year in a reliable way. What it controls with surgical precision is the short end of the curve. Overnight rates, 1 month, 3 month, 6 month, and 1-year funding costs. In other words, the exact maturities dominating the 2026 rollover. This is why rate cuts disproportionately benefit Treasury bills. Every quarter-point cut immediately lowers the yield on newly issued bills. That reduction flows straight into lower interest costs as existing short-term debt matures and is replaced. On a multi-trillion-dollar refinancing base, even a 50 basis point shift translates into tens of billions of dollars in annual savings. That is not a side effect. That is the core fiscal relief valve. Now layer in balance sheet policy. Quantitative tightening has been halted. That alone removes a major source of Treasury market pressure. But the pivot goes further. The central bank has resumed buying short-term securities. Not long bonds, not 10-year notes, bills and short notes. That matters because it creates an artificial floor under demand, exactly where refinancing volume is peaking. This is new money creation entering the system and flowing directly into the same instruments being rolled over. It is not stimulus in the traditional sense. It is a targeted liquidity bridge for sovereign refinancing. The central bank is quietly becoming a marginal buyer of its own government's short-term debt. This alignment is not accidental, it is necessity. Without short-end support, the Treasury would be forced to issue longer maturities at punitive yields. With it, the Treasury can keep compressing maturities, waiting for a political or economic moment when long-term yields can be forced lower through yield curve control, regulatory changes, or renewed long-end asset purchases. This reveals the deeper truth. The rollover is not just happening, it is being engineered. Monetary policy has been reoriented away from inflation control and toward debt service containment. That shift keeps the refinancing machine alive, and that leads to the final illusion that still survives. Even with liquidity and policy support in place, people still believe a default is lurking around the corner. That fear only exists because the mechanics have been misframed from the start. Once monetary policy is revealed as the stabilizer, the default narrative loses its last pillar. A sovereign default does not happen because a government runs out of money in the way households do. It happens when funding markets refuse to roll debt and buyers disappear. That condition does not exist here. Demand for treasuries is structurally embedded into the financial system. Banks are required to hold high-quality liquid assets. Money market funds are legally mandated to park cash in government securities. Brokerages automatically sweep idle balances into treasury-backed vehicles. Pension funds use treasuries as collateral. This is not optional behavior, it is regulatory plumbing. There is also no single moment where $9 trillion must be paid. The maturities are staggered across 12 months. Auctions occur weekly, settlement cycles are continuous. Each maturity is paired with a new issuance. There is no cliff edge. There is no default day. What exists is a rolling conveyor belt of expiring contracts and replacement contracts that update maturity dates without changing the funding base. This is why panic predictions keep failing. Even during the worst political standoffs, including debt ceiling crises, Treasury auctions continue to clear. Even during banking stress events, Treasury demand rises because institutions flee toward liquidity and safety. Even during equity bubbles, excess cash flows back into short-term government paper because regulatory frameworks force it there. The market is not free-floating. It is structurally captive. That makes a technical default in 2026 extraordinarily unlikely. Not because the fiscal position is healthy, but because the system has been engineered to prevent a funding seizure. Liquidity is being injected, rates are being cut at the short end. Issuance is being compressed into maturities the central bank can control. The plumbing is being reinforced, not abandoned. But that is exactly where the real danger begins to surface. The threat is not a dramatic collapse. It is a silent distortion. Each refinancing cycle pushes more debt into shorter maturities. Each short-end rate cut deepens reliance on central bank intervention. Each deficit layer compounds the rollover volume. This is not stabilization. It is dependency. Right now, total federal debt sits near $38 trillion. Annual deficits hover around $2 trillion. Even if interest costs temporarily flatten, the principal continues to grow. That means the volume of debt that must be refinanced every year will keep rising. Today, it is $9 trillion. In a few years, it could be $12 trillion. Then 15. The machine does not reset. It accelerates. This creates a structural trap. The more debt that shifts into short maturities, the more sensitive the system becomes to any policy mistake. A single failed auction, a single inflation surge, a single loss of confidence at the short end. Any one of these shocks would ripple instantly across trillions in refinancing volume. The buffer disappears. The margin for error collapses. At the same time, long-term refinancing is becoming politically and economically impossible. Long yields remain elevated because inflation expectations refuse to die. Investors demand a premium to lend for 20 or 30 years. That premium translates into interest rates near 5%. Locking in those rates would explode future interest costs, so the Treasury avoids it. And every time it avoids it, the maturity structure gets shorter. The fuse gets shorter. The dependency gets deeper. This is why the tools being discussed behind the scenes are not normal. Yield curve control, long-end quantitative easing, regulatory pressure on banks to absorb duration, financial repression policies that cap yields below inflation. These are not emergency measures. They are the only remaining mechanisms to force long-term borrowing costs down when markets refuse to cooperate voluntarily. And that leads directly into what comes after 2026. The refinancing event itself will pass quietly. Auctions will clear. Bills will roll. Interest costs may even dip temporarily. Headlines will move on. And most people will assume the problem is over. That assumption will be catastrophically wrong. What 2026 actually locks in is a permanent rollover regime, a system where debt is never retired, only extended. A structure where central bank policy is no longer about economic stability, but about keeping sovereign refinancing viable. A framework where deficits are no longer political debates, but mechanical inputs into an ever-expanding refinancing machine. From that point forward, every year becomes a mini 2026. Every year brings a larger maturity wall. Every year increases dependence on short-end rate control. Every year deepens the need for monetary distortion. The system does not break. It calcifies. This is the debt gravity trap. This is the debt gravity trap. The more the system leans on refinancing, the harder it becomes to escape refinancing. The more policy bends to support debt service, the less policy can fight inflation. The more liquidity is injected to stabilize rollovers, the more future inflation risk is embedded into the structure. So the real crisis is not default. It is normalization. It is the quiet acceptance that infinite rollover, permanent deficits, and engineered interest rates are no longer emergency tools. They are the operating model. 2026 will not be remembered as the year the United States ran out of money. It will be remembered as the year the system proved it never has to. And that realization is far more dangerous than any default headline could ever be.